Yeah, so it's always been an interesting time for municipal closed-end funds when short-term interest rates start to go up. Obviously, last time this really happened was in the earlier part of the century in sort of 2003, 2004. There are some obvious impacts, the most obvious of all being that the leverage that most of these funds typically use becomes more expensive, typically tied to short-term interest rates, and therefore as those interest rates go up, so the leverage that the funds use becomes more expensive, and so typically distributions that the funds make are hurt by this. The spread between what they can borrow at and what they can reinvest at is impacted. The real question is, so that is one factor to the distribution. The real question is, what is the impact on long-term rates? Obviously, often when short-term rates have moved up, so have long-term rates. We haven't really seen that yet. We've seen a little bit of it, but not in a major way. That is when the real sort of double whammy to municipal closed-end funds happens, because the movement in long-term rates, if they go up, is on the price of the underlying bonds in the portfolio. So in addition to that impact that short-term rates have on the distribution, you also get an impact on the price of the underlying municipal bonds. Yes, first of all, we do have a broad range of closed-end funds, and we have a broad range of open-end funds also. Often both of these vehicles are managed by the same teams and the same individuals, and certainly if you ask them which structure they would prefer to be managing, I think in every instance they'd say they'd rather be managing a closed-end fund, mostly because of the liquidity involvement of the closed-end fund, where in a time when people are selling the fund, that has an impact on the market price. It might send the price to a discount, but it has no impact on the underlying portfolio. The portfolio manager isn't having to sell securities because people have decided they want to sell the fund. In an open-end fund, obviously the opposite of true is true, where if a fund goes out of favor or an asset class goes out of favor, people decide to redeem their shares of the fund, the portfolio manager has got to go and sell things to meet those redemptions. So significant difference between open-end and closed-end, significant advantage, I would say, to the closed-end fund in that space, and it's why in many cases our active managers like to manage in the closed-end fund vehicle. So as we see short-term rates rising and likely continuing to rise, rightly or wrongly, there has been an impact on both the tax-exempt and the taxable fixed income closed-end funds, and many of them have gone to significant discounts during that period. The impact on the underlying securities in the equity space, whether they're equity income funds or equity option funds, and we manage both at Eaton Vance, is significantly reduced from what we're seeing on the fixed income side. We've already seen discounts or indeed premiums begin to appear in our equity funds, I think because people have started to make this shift out of fixed income and into the equity space in the closed-end fund world. So probably something we're likely going to continue to see. It's another place that people can get income, and it's nice to see many of our funds trading so well right now.